Good evening. Welcome to the final presentation of the 2014 Personal Financial Planning Lecture Series. My name is Nicholas Raculia, and I am an Assistant Professor of Finance here at St. Vincent College and the Director of this series. The Personal Financial Planning Lecture Series is sponsored by the McKenna School of Business, Economics, and Government, and it is in its 6th year. We are grateful for the generous support of our friends. Without the support of Federated Investors, Heffron Tillotson, the Second Half Coach, Dollar Bank, TIAA CREF, and BNY Mellon, we could not bring in the quality of speakers like tonight. Special thanks also goes out to Dean Quinlivan for his unwavering support of the series, and to my colleague Mark Abramovic for founding the series. So thank you to both of those fine gentlemen. Also, thank you to the Finance Club for their outstanding work tonight in helping me organize this, hand out all of the various papers that you see around you. And speaking of which, a little bit of housekeeping before I introduce our speaker, our moderator for tonight. On your seats, you see a white note card and a manila card. The white note card is going to be for any questions that you might have for our speakers after their formal remarks have finished. Once you're done with writing out your question, once they're done with their formal remarks, send them to the sides. Our Finance Club will be around to pick them up. The second card is if you would like to, and you're not on our mailing list, please either write down your address or your email address. And then if you have any topics that you'd like us to cover in the future, please write them down there, and we'll do our best to get to all of them. All right, let me now turn it over to the moderator of tonight's event. Jayme Meredith is a vice president at Heffron Tillotson. He is a St. Vincent College alum, class of '93, and he sits on our McKenna Advisory Board. He's also an adjunct professor, and I welcome Jayme to the podium.
Well, thank you, everyone. Can everybody hear me okay? No? Okay. Well, I will talk loud. Is this working? Is it working now? Okay. Well, thank you for spending your evening, and thank you for bearing with a little bit of technical difficulties, but we're up and running now. We're very excited to be here. As Professor Raculia mentioned, I am an alum of St. Vincent College. I'm very excited to be back. I'm teaching a class on Wednesday night, so I love the institution, and I love the fact that I can bring out a lot of my very, very smart colleagues to hopefully incite some wisdom and some knowledge to everyone tonight. Before I hand it over and introduce these guests, I just want to thank Dr. Quinlivan for reconnecting me with the college and inviting us out here tonight. Dr. Raculia, certainly with all the efforts of putting this wonderful session on. This is actually my second time speaking here. That was a couple years ago, so again, very excited to be here. Want to introduce a few people in the crowd, just to acknowledge some very special people in the crowd. Somewhere around here we have Matthew Snyder, who is the manager of our branch office at Heffron Tillotson. We just opened a branch here. Mr. Snyder's back there. Want to also acknowledge who here listens to the radio show? Anybody here radio show listeners? All right. Well, big question here. Anybody here just tonight to see what Jim Meredith looks like? Okay, I thought we had a few honest people. But for you radio show listeners, I want to introduce Rob Pratt. He's right in the middle. Rob is a great friend of Heffron Tillotson. I also want to acknowledge in the front Jack D'Amico. A lot of people, Jack's name isn't as well known as Mr. Pratt, but Jack has worked with us for a long time. And any Steeler fans that have gone to the stadium and heard the Heffron Tillotson Great Returns commercial, we can all thank Mr. D'Amico for that. So thank you, Jack. Good friend of Heffron Tillotson. So, we are here tonight. Again, we want to make a panel. We've got various experts from our firm. We're going to talk about what's going on in the world for about 45 minutes, and then we want to open it up for questions. So there's a couple questions that I've thought of, some really hard ones that I want to pose to our panel, see if I can stump them. But as Dr. Raculia said, certainly we encourage your questions. So if you have questions, please fill out the form, raise your hand, and we'll collect those. But I want to introduce from your right, my right, your right as well, I guess, Brian Coble. Brian is a chartered financial analyst, which I can say is a very difficult thing to achieve. Brian has been with Heffron Tillotson for nearly 10 years. Brian is our director of research. Brian makes me sound a lot smarter than I actually am, because I take what Brian sends us an email and I tell it to my clients and I pretend that it's mine. To Brian's right is Tim Davis. Tim has also been with Heffron for a long time now. Tim is, and I say this very affectionately, Tim is the smartest bond guy I've ever met. And I spent a lot of time...
He's only met one.
Yeah, I've only met one, so it kind of narrows it down. But Tim has been in the bond business for 40 years. With almost anything you can think about with fixed income, Tim has done it. And we're very, very lucky, very, very privileged to have someone like Tim Davis in our firm. And Tim's going to talk about big news, interest rates, the Fed, bonds. We're going to talk about that. And then, last but not least, we have our very own Jim Meredith. Jim is going to wrap everything up. He's going to tie all of this fun stuff together and talk about where we're at and some of the things that we can look at going forward. So, before any further ado, let me turn things over to Mr. Coble.
Okay, thank you so much, Jayme. It's great to be here. I actually received a few comments that I might not meet the age limit to be on this panel this evening, but these are two men, Tim and Jim, that I'm very pleased to be with, and two colleagues that are mentors to me, and two people that I admire, and I should say two people that can tell us how to get the most out of Social Security. So it is very good to be here tonight. I am going to start with a review of the stock market. And this is what the stock market looked like 5 years ago. Okay, it's been 5 years since the bear market bottom.
You're off on this slide for me. You got it back up.
No, I think
that's right.
Yeah.
I'm sorry.
No.
I'll shut up.
So this is the depths of the financial crisis, March of 2009. And a 60% drop in the S&P 500 exceeded the previous drop following the tech bubble. And it doesn't seem like that long ago, does it? Does anyone remember this little episode that we went through? Yeah, it doesn't seem like 5 years, and I think the reason for that is that investors were so traumatized by the experience that it's an experience that we carry with us. Okay, and so if you're someone who's maybe a baby boomer approaching retirement, this is probably an experience that you're going to be carrying with you throughout the rest of your investment experience. And so over the next decades, you're going to need to think about approaching the markets without considering the specter of 2008 always haunting you. Okay? But that was then, and like the old tobacco commercial used to say, you've come a long way, baby. This is now. Okay, this is the S&P 500 today. We've had a tremendous run, and we are at new all-time highs exceeding the 2000 peak and also the 2007 peak. Okay. If you had invested $10,000 at the market low 5 years ago in various areas of the investment markets, this is what it would look like today. Okay, so $10,000 invested in real estate investment trust, all the way on the left side of the screen, would have grown to $40,000. An investment in energy MLPs, master limited partnerships, would have grown to $37,000. An investment in the stock market, the S&P 500, would have grown to $30,000. Even areas of the bond market have done very well. High-yield corporate bonds have more than doubled. But look at all the way on the right-hand side of the screen, T-bills, in other words, cash. If you had invested $10,000 in cash and just let it sit there, your investment today would be worth $10,033. That's all the more it would have grown. And it would take a long time to double your money at that rate of return. Okay. Unfortunately, a lot of people have sat out this record bull market. So this chart shows year by year, over the last 20 years, inflows into U.S. equity mutual funds. Okay, and you can see starting in 2008, investors pulled money out of U.S. equity funds 5 years in a row to the tune of hundreds of billions of dollars. Okay, and it wasn't until last year, 2013, as the market rose 32% last year, that investors finally came back to the market. So we've had this record run in the market, but not everyone has participated. Okay, what really interests me is that this record rise in the stock market isn't necessarily intuitive. Okay, so if you think about your own personal situation, if you think about the situation of your friends and family, if you think about what you see on the news every night, if you think about what's happening in Washington, it doesn't necessarily make sense that the stock market would have done as well as it has. Would you agree with that? And this evening, I want to go through 3 reasons why the stock market has done so well. And I think it'll set us up well for eventually Jim to talk about what we expect going forward. So it's easy to lose sight of the fact that when you invest in the stock market, you're investing in companies, right? And the value of those companies is determined by the earnings that they generate, okay? So earnings dictate the value of companies, and the value of the companies dictates the direction of the stock market, okay? So this chart is the first reason that the equity market has done so well. It's that earnings have done so well. So the black line is the S&P 500. The red line are the earnings generated by companies in the S&P 500 index. Okay, and look what's happened over the last 5 years. Earnings have skyrocketed. And when you think of it in this light, the stock market has behaved exactly as you might expect. Okay, the rise in the stock market has corresponded to the rise in corporate earnings. Okay, and in fact, if you look at this chart, if you divide the black line by the red line, in other words, divide the price of the S&P 500 by the earnings generated by S&P 500 companies, you get the price to earnings ratio, right? The PE ratio, which is what we use to value the stock market. Here's the PE ratio going back 60 years. You can see today we're at 17.4, just slightly above the 60-year average of about 16 times. So you can say the stock market is slightly overvalued relative to its historic norms, but not significantly overvalued. In fact, we'd probably say the stock market is reasonably priced. It's appropriately priced based on the strong earnings that we've seen. This raises another question. Why have earnings been so strong, despite the fact that the economy hasn't necessarily been so strong? Okay, so this chart, we use some of the same data, I've just scaled it differently. So the black line is the S&P 500. The red line is earnings generated by S&P 500 companies, and this is since the market low 5 years ago. The green line is a measure of US GDP, and the blue line is a measure of payrolls. So look at this, we've had this tremendous bull market in stocks, a tremendous rise in earnings, despite rather anemic economic growth and very modest jobs growth. So I'll just throw this out there. How do we reconcile those two things? Why are earnings so strong despite a somewhat lackluster economy? Any thoughts? Global economy. So offshoring to reduce costs, but also open globalization in terms of increased exports. So companies are now exporting around the world. That's a big reason.
Lower interest rates.
Lower interest rates. So I had thought of 3 reasons. We have 2 of them. So companies are borrowing at very low rates, and that increases their profitability because their interest costs are down. And the third one really relates to the jobs. It would be the increase in automation and robotics, right? That increases the productivity of companies. Another reason, or I guess all of this really is a way of saying that US companies are really, really, really good at making money. Okay, as Americans, that's what we're good at, making money. And I want to point to just one little dynamic that I think you can all relate to that is sort of a microcosm for this. Has anyone walked into the grocery store over the last few years, got your receipt, and did a double take when you saw how much your grocery bill was? Does that sound familiar? Okay, I see nodding heads and rolling eyes. Or maybe you've also experienced, you go to get the box of cookies, there used to be 12 in it, and now there's only 10, right? You've seen that, or maybe that carton of ice cream used to be a quart, but now it's slightly less. Okay, I want to use the example of Tide detergent made by Procter & Gamble. This is a fun site. It's called mouseprint.org. It looks at kind of the fine print of different items, consumer items. In any event, Tide has shrunk its packaging So if you look on the left-hand side, if you bought a container of Tide a few years ago, you used to get 100 ounces, and now you only get 92. If you look on the top right, they've shrunk the number of loads that a container will accommodate from 60 to 48. And if you notice here, the ounces drop by 8%, but the number of loads drops by 20%, and yet the price has not gone down. So what's going on here? Well, if you look at the bottom right chart, or I'm sorry, the bottom right picture, it turns out they've actually changed the measuring cup to entice you to use more liquid with each load of laundry. And as I was thinking through this, the only thing I could think of is perhaps they're actually diluting the detergent, okay? And I think you know what the punchline is here. Okay, this is Procter & Gamble, the maker of Tide. This is their stock price in black, and these are their earnings per share in red, okay? Procter & Gamble has been making money hand over fist, and if you've been invested in Procter & Gamble stock, either directly or through your mutual fund, you've also been making money hand over fist, okay? So the next time you're in the grocery store or wherever it might be and you're feeling a little shortchanged, don't get mad, get even, buy Procter & Gamble stock. If you're upset the next time you go to fill up your gas tank, don't get mad, buy Exxon, right? So U.S. companies are extremely adept at making money, and that's a big reason that the stock market has done so well despite the lackluster economy. Okay, the second reason has to do with the Federal Reserve. As you know, the Federal Reserve has just undergone extraordinary stimulus measures of the last 5 years, stimulus measures that it continues to undergo. So this chart shows the S&P 500 in black, and the dark red line are the assets on the Federal Reserve's balance sheet. Okay, so this is another way of saying how much money has the Fed injected into the economy. And if you look at that red line, it's just skyrocketed. The Fed has injected more than $4 trillion into the economy. It is now tapering, is the word they use, its purchases. So it was, as of December, it was injecting $85 billion a month. It's now down to $55 billion a month, and they anticipate by the end of the year they're going to no longer be injecting money into the economy. Now, when we look at this chart, I think we want to avoid two extremes. There's actually a lot of people out there who say that the Federal Reserve has nothing to do with the rise in the stock market. Okay? That's a very common position among folks on Wall Street. And I like to say, my older daughter is in kindergarten and she's learning patterns. I think if she were looking at this chart, she might even be able to pick up the pattern. I think the Fed has had something to do with the rise in the stock market. At the other extreme, we have a lot of people who say the rise in stocks is illusory and it's just something that's been manufactured by the Fed and it's entirely the Fed's artificial construction that is the rise in stocks. Well, I don't think that's the case either. As we just saw, earnings have skyrocketed, so it makes sense that the stock market has done so well. So I think a reasonable thing to say is that the stock market has a fundamental basis in the rise in earnings, but perhaps it's been amplified somewhat by what the Federal Reserve has done. And because the Fed has been so important in terms of the stock market in the past, what the Fed does in the future, over the next few years, is also going to be very important in terms of the direction of the stock market. The last reason I'll touch on for the stock market doing so well has to do with the federal budget deficit and the fact that the federal budget deficit has actually improved quite a bit over the last few years. And I call this chart the end of the world, or if you know the acronym that's popular on the internet, the end of the world as we know it, okay? So if you look at this chart, this is the federal budget deficit going back to the 1960s. And you can see today we're at 3.3% deficit as a percentage of GDP. That is a meaningful deficit, but it is much better than where we were a few years ago when we were at a 10 percentage point deficit. And in fact, we're almost to the long-term average of 2.7%. And we're actually in better shape than we were during some periods of the 90s and the 80s. Okay. And I like to compare the stock market to a hot air balloon. There's two ways for a hot air balloon to go higher. You can either pull the cord and have it thrust higher, or you can cut the sandbags, okay? As the concern about the federal budget deficit has alleviated over the last 18 months, it's been like cutting a sandbag off the stock market, as everyone who was concerned about the so-called end of the world, end of the fiscal world, no longer today is as concerned, okay? It's not to say that the situation in Washington is fixed. It's only to say that the probability of a crisis over the near term is much, much, much lower today than it was just a few years ago. And the reason for that is the budget deficit is shrinking thanks to we have the sequester, which actually cuts spending, and then we've also had this tax increase, together with an improving economy, has really increased tax revenues into the federal government. So the budget situation in Washington is a long-term concern, but I think it's something I actually worry more about for my 3 little kids and their futures than I do over any immediate time frame. So we've spoken some about the U.S. market. I just want to turn our attention, just for 2 minutes, to the overseas markets, because a lot of folks have seen the run-up in the stock market, and they aren't in a hurry to invest at all-time highs. And, it's been a long time since we've had a bear market, 5 years now. And a lot of folks worry about investing at these levels. If that describes you, I would urge you to look at the overseas markets. So here we have the S&P 500 in black, foreign developed markets in red. This would be, for example, Europe, Japan, Canada, Scandinavia. And in blue we have the price performance of the emerging markets. So this would be China, India, Russia, Brazil, and so on. And these lines are indexed to 100 as of the market peak in 2007. Okay, and you can see the black line, the S&P 500, is well above its historic highs. But look at the red line and the blue line. Foreign developed stocks and emerging markets are both 17, 18% below their 2007 highs 7 years ago. Okay, so these markets have not appreciated as much. And if you're a little gun shy about the stock market, this would be an interesting place to look. And then just one final slide relating to valuation. This chart shows the PE ratio, the estimated PE ratio based on next year's earnings for the US in black, those foreign developed markets in red, and the emerging markets in blue. And you can see how a valuation disparity has opened up over the last few years as US stocks have done so well and those other markets have lagged. So overseas stocks now trade at a meaningful discount to the US, particularly emerging markets where some of the long-term growth dynamics are attractive. So again, if you're a little gun shy on the US stock market, think about perhaps increasing your exposure to overseas markets within the context of proper asset allocation and portfolio construction. Thank you. I'll turn it over to Tim.
Thank you, Brian. I'm going to be a lot shorter. I'm going to be reckless. We'll just do this. I'm going to be a lot shorter. I only have 4 slides. The main reason is Brian said I'm old and I don't know how to create slides. And he wouldn't help me today. But I want to get one simple point across. I want to talk about interest rates. And I want to talk about where they're going, because that seems to be what everybody always wants to know about interest rates. Interest rates are so low they have to go higher. We've been hearing that for 20 years or more. Interest rates are so low that the Fed is going to start to raise interest rates. So when the Fed raises interest rates have to go higher, because that's what that means. Right? Maybe not the case. When we talk about interest rates and we talk about yields, and I'm going to use those terms interchangeably, we have to talk about the duration of those interest rates. We'll get into this in more detail. When the Fed raises interest rates, they're raising interest rates on overnight lending rates to banks. 12 hours, 24 hours, whatever it is. That's what they're raising. But when you look at bonds, you can buy bonds that mature from a 3-month T-bill, let's say, to a 30-year long bond. or 20 years, or 22, or 18 and a half. You can pick a maturity anywhere from really tomorrow out to 2057. We've seen bond issues recently. So if the Fed is going to raise interest rates, we know what it's going to impact, the overnight lending rate. How's it going to impact the longer bonds? And if you own bonds, if the Fed is going to raise interest rates, then, wow, the bonds that I own are going to go down in value. And it just, that goes without saying. In fact, I was in 2 meetings recently in D.C. At a boardroom, and the head of FINRA, who's our regulatory body, the head of FINRA was there, and the lead attorney, the head attorney for FINRA was there, and they were counseling us bond trader types that we better really educate our clients and investors when selling them longer dated maturities. Because when the Fed starts to raise interest rates, their value is going to fall. And they were very definitive. There was no give. They knew they had a crystal ball. And I was amazed at that sitting in that boardroom, because my colleague here, Brian, I'll quote him for a second, has always said that predicting the stock market is impossible, but predicting bonds is even harder. So how can they make these predictions? Nobody can. But we can look backward. We can see what history tells us, and I think that's the way we should go to see what the future holds for us. And the first slide, you can help me, thank you. The first slide is a yield curve. Now, a yield curve is created by the yields or the interest rates. This is on U.S. Treasuries, notes, and bonds. And you can see, if you can, down at the bottom, it starts off at 1 month, then 3 months, 6 months, 1 year, 3 years, and so on. And as interest rates rise, that curve rises. And then when we get up to around 10 years or 15 years, it sort of stops it's not rising so steep. Excuse me. This is the yield curve on U.S. Treasuries from April the 2nd. You can see it's very, very steep. Just to let you know, if I had a pointer, if you would even that out, if you would go from 1 month to about 7 years, almost straight up, that would be a normal yield curve. This yield curve is extremely steep. And what it tells you is that in order to extend your purchases out 7 years, 10 years, 20 years, 30 years, an investor is demanding more yield or a higher interest rate than those who are staying within 2 years, because the money wants to stay within 2 years because they're afraid of the future. And they're afraid that when the Fed starts to raise interest rates, that's really going to affect the value of their bonds. So we have an extremely steep yield curve right now. We're still recommending that bond investors stay within what we call the belly of the curve. You can see it around 10 years to 15 years where it really flattens out. So you can maximize your interest rate without going too long, without exposing your bonds to real time risk. You can see that the 1 year is yielding only 8 basis points. That's all that it's paying on a 1 year Treasury note. The 2 year Treasury note is paying 34 basis points, so that's quite an increase, but that's still nothing. That's still negligible. But when you go out to 10 years, it opened this morning at 2.66%. So in 8 years, you can climb 230 basis points, or 2.33% on your investment. Now, the next slide, and I'm going to almost duplicate this. I'm going to show this in 2 other fashions. Let's go back to 2004, June 2004 through June 2006. That was a period of Fed tightening. Tightening is when the Fed raises interest rates, raises the overnight lending rate. And back in June of 2004, the Fed's overnight lending rate, or the Fed funds rate, was 1%, back in May, that is. And in June, you can see on the bottom left-hand side, June 2004, they raised the rate to 1.25%, 25 basis points. Then in August, they had no meeting in July. In August, they raised the rate to 1.5%. Then in September, 1.75%, 2%, and then you go to the bottom of the center column. In February of 2005, they had taken it up to 2.5%. You can follow that progression all the way up through December of that year to 4.25%. And let's go over to the far right bottom, and we open up in January 2006 at 4.5%. And in June of 2006, exactly 2 years after the Fed started to raise interest rates, they ended at 5.25%. That's a very, very hefty move over a 2-year period from 1% to 5.25%. You would think that would have taken yields on long bonds and skyrocketed those. You would think that you could be buying 7, 8, 9% bonds going 20 years or 30 years. And you would think that if you started off owning a 15 or 20 or 30-year bond during that time, your value would have really dipped. You'd now be in the 80s somewhere if you paid par for your bonds. So if we look at the next slide, it's just a graph showing you another way of illustrating those incremental interest rate rises over 2 years. Just to give you another idea about how high that went. And if we look at the last slide, that's a yield curve, and you can see on the white line, that was June of 2004, when the overnight lending rate was 1% raised to 1.25%. You can see that's the normal yield curve I was talking about on the first slide. It is fairly steep, but it's historically an accurate normal yield curve from 1 year to 10 years, and then it starts to even out again. So starting off with that type of a yield curve, a normal curve, and then 2 years later with the red line ending up in June 2006 at 5.25%, you can see what happened to the short end of that yield curve. Interest rates on the short end did rise from 1% to 5%. And then they just started to flatten out. And so by the time you reach around a 20-year bond, the end of this curve is 30 years. So by the time you reached around a 20-year bond, 18, 15 years to 20 years, the effect on your 20-year bond was almost negligible. Those interest rates did not rise to 6, 7, 8, 9% as you would think that they would do. They held firm. As a matter of fact, after a 2-year period, technically the 30-year Treasury bond was yielding, or the interest rate was exactly the same as it was 2 years before, when the Fed was at 1%. The same as it was at the end of June 2006, when the Fed stopped at 5.25%. So we don't know the future. We can't predict the future. We can go back and we can see everything that was in place in the economy at this time in 2004, 2005, 2006. It isn't the same as it was today, or is it today? Probably not the same as it's going to be a year and a half or a year and 3 quarters from now when the latest prediction is the Fed will begin to raise rates maybe a year and a half or maybe a year and 3 quarters from now. Still a significant period of time. It's a lot of time to build rate increases into the market and to prepare yourself and position yourself in the curve. But history says when the Fed starts to raise rates, it isn't going to have an effect on the long bond. This time around, I don't think it's going to look exactly like this, but I think there's still going to be some protection in owning that belly of the curve, and I don't think we have to be afraid of it. I think what could disrupt that entire process is Janet Yellen starts to chase inflation and isn't ahead of it. I think inflation is the real fear, but the way the economy is growing and some of the things that Brian just illustrated, the slowness of the growth, I don't think we have to worry about that. I think we have everything in place for a calmer market, and I don't see a need for the Fed to tighten 5% or more. So that's my little pitch for this evening. Stay calm. What's the English thing now? You stay calm and carry on, stay quiet and carry on. I'd like to introduce Jim Meredith.
My daughter has informed me that I am older than dirt, so I think I'm 2 weeks older than Tim. So. Let me tell you about these two guys sitting next to me. When we hired Brian a long time ago, the word came down, and I was one of the people that interviewed him. Keep him busy. This guy is scary smart, and we're going to make him an offer right away. And he, for you students in the room, you want to find out what hard work gets you, take a look at Brian Coble. Tim Davis, on the other hand, is, I didn't mean it that way. We get along well.
He introduced me as being in debt for over 40 years.
But I would, you remember Carl Sagan? And we talked about billions and billions of stars. Well, that's how I introduced him. This fellow has received numerous industry awards and accolation, if that's a correct word. I'm from the Keysport, so bear with me. And he sits on MSRB and SIFMA, and he is an arbiter on disputes. And these are really, really powerful, knowledgeable guys that come out here, and I appreciate them coming out. And I get to talk on Sunday mornings when Rob lets me. But this is some of the firepower that we have now. Next Sunday, I'm not there. Next month is my 28th anniversary on the air. So these guys are sitting in for me 4 times a year. So my wife has said, did I marry you or did I marry KDKA? So anyhow, now let me ask, Dr. Quinlan, can I editorialize for 5 minutes here?
Go ahead.
How many students we have in the room? Okay. How many are here because your teachers are in the back of the room? I'm going to address you. I say a lot of elbows. This is an incredible learning institution. I've taught in college campuses. I've lectured across the country in college campuses. This is an incredible institution. Appreciate it because the days will go by in a blink. How many parents of St. Vincent students in the room? Well, we had a lot across all. I sent 1.5 here. My half student took 9 years between his sophomore and his junior year. And he's now off in the world of computer science. And he says he's better looking than my oldest son that you saw here. But they have that rivalry all the time. And so for you students in the room, man, this is the best of time. Truly, 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 this is the best of time. You are receiving more information in a day than we got in a month when we were in college. When I was in college, this guy named Edison just invented electricity. The information processing, and I want to touch back on this, but I heard this story today. It's nothing to do with the topic, but I thought it was funny. Bear with me. There was an older couple. The wife was 85 and the husband was 89, and they lived in a rural community. It was about the 15th or 20th time they got caught shoplifting in Walmart. So Walmart said, we're going to prosecute, enough warnings. So they went into court, and the judge said, why are you here? And the DA said, they're habitual criminals. We respect their age. They've been married 60 years, but they won't listen. So the judge asked the woman to stand up, and he said, is it true you've been caught over 20 times? Yes, Your Honor. Well, why did you steal? Well, I'm hungry. Well, what did you steal? And she said, a can of peaches. And he said, well, how many peaches were in the can? She said, 6. He said, okay, I'm sentencing you to 6 days in jail. And the husband stood up and said, Your Honor, may I address the court? And he said, yes. And he said, she also stole a can of peas. So, I thought it was good. Here's, in my 2 hours a week in media business, there was and we study a lot. For you students, I know Brian and Tim do the same thing. Get ready, guys. I've been in the business for 47 years. That's scary. I read 40 to 50 hours a week on top of the work schedule. You have to. Study doesn't stop, it starts. So you have to build the foundation here. There is a human tendency in the news to believe bad news is more reliable than good news. What do they lead with in the news? The world's going to end. Stay tuned. We'll be back after this break. So, and it is human nature to believe negative thought is more reliable and more accurate than positive thought. So there's a lot of negatives every day. You watch the news, and they're right before they go to a break, no matter if it's CNBC or MSN or Fox or whatever, it's a wham to get you and hook you. And then it didn't turn out that bad. But how many would stay up till 11 o'clock and they said, well, the Lutheran Church got 800 people this week, the Methodist 600. You turn the channel. You would turn the channel. So beware that information media is there to sell the soap, not to inform. Would you agree, Mr. Pratt?
I would agree, yeah.
It's there to sell the soap. And so be very, very careful. Observe it all, analyze it all, but do not rush to judgment with a momentary headline. That's how you get in trouble. Now, these are the facts, and I'm going to say at a macro level, there are positives. We have accommodative monetary policy, the rebound in capital spending, stronger household balance sheets, auto sector recovery. Listen to the car ads on the radio, every other ad, housing, energy production, improving budget deficits, manufacturing comeback. What are the negatives? Long-term government debt trend, bottoming of inflation, unwinding aggressive Fed policy, and then maybe the most important for everybody in this room is political dysfunction. Political dysfunction. Now, on the macroeconomic level, and in my almost 28 years, a couple of weeks ago, I had this young, smart Princeton PhD sitting at my elbow, And I had to, somebody came with some technical questions, which I answered, and Nick said, B minus.
C plus.
So, is he a tough grader? Yeah, they're all, yeah, you don't see the looks. So, this is, first and foremost, in every economy, there is a business cycle. It is like the changing of the season. Thank goodness winter, I hope, is gone. Okay, I hope it's gone. Now, what I need you to do is take in your mind's eye, the capital letter S, and turn it on its side, and that's a business cycle. Now, what happens is, we have the early, mid, late, and recession. And you're seeing here in this, another advantage, we're registered investment advisors, so we get to steal research from everybody. This is from Fidelity, and they put this out, but it talks about the present state of the business cycle in the major economies of the world. Now, what happens, and I caution people, and you students, pay attention, wake up, guys. Every investment cycle is a mountain. They go up, they make plateau, and then they get down. If you don't know which side of the hill you're on, don't get into the game. Do not get into the game. There's an old saying, if you sit at a poker table and you can't see the sucker in 5 minutes, stand up, move away, it's you. Okay, now, what happens is this. All businesses, and Brian talked about the absence of wage growth in this country. When the economy begins to slow, that's when wages rise. Because generally capacity is filled and profit margins, because there's a huge gap with the growth on capital versus growth on wages. But wages begin to rise in the second part of this curve. Now, we're in an election year, a midterm election year, that has an enormous influence on this market, short term. And what happens is you see the U.S. that's just cresting now the hill. Now is the time for a government to create fiscal incentives to try and miss that downslope on the other side of the S-curve and continue the economy upward. Generally, what do? They create tax credits for businesses to hire people. They incentivize depreciation guidelines, all these things. The big debate is repatriation of non-U.S. profits in this. I can't get into that in detail. But we are owed a responsible fiscal policy in Washington, because the seasons are changing in this economy. This is an interesting day to do this talk, the way the markets cracked today. And Brian told you so. We were in a long, lengthy meeting. We managed billions and billions of dollars for thousands of families. And we don't always disagree on every minutiae subject, but the business cycle is absolutely not a crisis. It is no more than April turning into September. So that's a natural function. However, the monetary policy, as Tim has said, the gas pedal's all the way down. They're easing up on it a little bit with quantitative easing and all this stuff. The brake pedal, Yellen or Bernanke threw it out the window. I don't know what the Fed's going to do to slow things down. That's come back next year, we'll tell you. But The monetary policy only goes so far. You need stimulus as well. Now, as an example, and bear with me on this, I used to do a talk many times. There's three things you need to live: food, water, and oxygen. Food, maybe a month, you can go without. Water, 10 days, 2 weeks maybe. Oxygen, a minute, 2 minutes. In a fiscal economy, credit is the oxygen. And back in 2008, when everything imploded, there was no credit. And Brian, you students ought to line up and ask him for his email. You great in answering your homework, but we had a correlation of 1. Everything went down. Why? Because somebody shut off the oxygen. That's what happened. That's what happened. The credit sources dried up. Homes were repossessed, people forced into bankruptcy, companies closed, the oxygen pipe was cut off. Fiscal policy, not monetary policy, did not respond. That's our elected officials. Now, for you students in the room, your competition as a graduating student from St. Vincent College is not going to come from somebody at Pitt or Penn State. It's going to come from somebody in Beijing. Your world is different than ours. The world got a lot smaller. And my son Jayme, I'll embarrass him, I remember when he was a grad student at CMU in the Tepper School. And he was taking this advanced math course, and some other students were asking him for help. But they were competitive, and they were trying to sidetrack him on a competitive basis. Yeah. And so what happens is this world is shrinking. And as a parent and a grandparent, guys and girls, or ladies and gentlemen, you've got to get ready. Because over there, it's amazing. Just one last editorial. In Korea, and the rest of the competitive world, their kids don't get off on summer vacation in primary grades or high school. So when they graduate, they have 2.5 more years of education than you guys do when they start college. They're beginning college like a college junior in this country. That is your competition. Recognize that. Really, truly recognize that. But let me go on. You're going to hear a lot about this. The influence of the midterm election years. Barron's magazine last weekend has talked about this. The market corrections during years of midterm elections. Every year since 1962, in the middle of the year, the markets have fallen between 8 and 34%. But after the election, for every percent of decline, it is recovered 150%. So if what we have done in our advisory clients, those living on their wealth, and those, I don't know why you're not clients of Pepperin, put that plug in, but you should consider, and what we did early, when did we do that? Early January, when the markets were at their peak, we took some money off and put it on the shelf equal to what they were going to spend this year. So that spending money is not subject to the market influence or the whims of the market. Now, there's an old saying, sell in May and go away. this could be a year, but this is not a year to panic. And I have to hurry up. Okay. Do I have to hurry up or can I keep going? All right. He's like Rob. There's a lot that goes on in radio show that you don't get to see. I was told a long time ago I had a face for radio. So. All right. This is data from Ned Davis Research. The Wall Street Journal, CNBC, they quote this research. Ask Brian, he memorizes it every day when the 100 pages come out. You see, what happens, and I don't have a pointer, but at the peak on the left-hand side, that's around May. And then the markets twiddle down, and then right after the election, zoom, they shoot up. We're anticipating a very bumpy ride this year, and as an example, at the close of the market today, the VIX was over 20, and because of the new market and the high frequency guys, etc. But this is not, if you're in a market that begins to experience, normal volatility, which we haven't seen in a long time, don't be afraid of it. Don't be afraid of it. How do you not get seasick? Keep your eyes on the horizon. Keep the goals and objectives in mind. Maybe raise your cash needs now, or if you have cash to come into the market, it's called dollar cost averaging. Empiric studies, which mean for pretend, the most perfect way to bring money into the market is about 100 trading days. So 6-month DCA, 3-month DCA. Now, why does the market shoot up right after the election? The anxiety is over. Who's going to win? I don't know. If we have a divided Congress or a Republican Congress, probably in the industrial stocks and the defense stocks may rise. If we wind up with a Democratic Congress, probably the healthcare stocks will rise. So, but the market as a total will rise. Leave it to the pros to pick the sectors. Do not panic if this pattern repeats. Because in every year, that is the average chart, the average from 1928 to 12/31/13. No year is average, but all years end higher. There has never been a time in the history of the S&P 500, students, when was the S&P created? Come on, guys, anybody know? 1929. There has never been a 12-month period of time in the history of the S&P that the market has lost money in the 12 months following a mid-year election. Don't overreact to Jim Cramer on CNBC screaming, sell, sell, sell. Sell, sell, sell. Now, as Mr. Pratt can indicate, on Sunday mornings, I got nothing. He has 6 analysts and about 12 computer screens feeding his answers. I once, a long time ago, knew Jim Cramer, but he's a very, 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 very brilliant man. He's real, but he's also a little bit of P.T. Barnum on. It doesn't work like that. Brian Coble does not act like that every morning in the office. That is not the way we look at the market. You should not either. It's not like that. It really is not like that. This next slide, and I wish you could see it in detail. That was in a critical research piece, Why Capitalism is Evil. It was on Salon.com a couple of years ago. And what those are the 10 largest consumer staple companies in the world. They're in there: Procter & Gamble, Nestle's, Kraft, Coca-Cola, Pepsi, Kellogg, Mars, Unilever, and Johnson & Johnson. They control 75% of the consumer goods you buy. 10 companies. How many of you realize that Ralph Lauren is owned by Nestle's chocolate? Yves Saint Laurent, you know, those $2,000 purses. Next time you see one, that's the same people that make new Coke. Okay? Now, that is the way you need to look at a stock market. If the market, the Dow fell 250 some points today, you're still going to go to the supermarket and buy Crest, or you may not buy an Yves Saint Laurent purse. Maybe you'll buy two because of one sale. But that is what the stock market is. As Brian said, it's earnings, it's companies. All those goods up there, and Unilever and Nestle, they're foreign companies. Safeguard Soap, that's a foreign company. And Mars is in there as well. Who did Mars just bought somebody? I just yeah, they're buying. Yeah, they bought the dog food business from Procter & Gamble. So, but they wrote a check. Corporate America is incredibly healthy because they're run by pros. They're up to their eyeballs in cash. And I ran across this thing last night. Apple has more cash than the nation of Germany. Think about that. Think about that, you Volkswagen owners. Apple has about 3 times the cash of the nation of Germany. That's what, the 4th largest company in the world. Apple has more money than that. Do not be afraid of the negatives. Let me summarize it this way. Bad news sells soap. There is a preponderance of belief that negative news is more reliable than positive news. Why? It has to do with the genes that the Creator gave us. Why? Because it's fight or flight, gut instinct, and all those things. Now, one last thing, and we'll open up the slides. And I apologize. Anybody want to go home? No? Okay. We're running way over. Okay. I got a call from a client, and his first name is Bill. And he called me Monday. What day is this? Thursday. Yeah, it was Monday he called me. And he left a voicemail. And I had to call him back when I heard the voicemail because we're always in meetings. And I said, Bill, it's Jim. You sound like your dog died or you just came from your accountant's office. And he said, I don't own a dog, but you're right. The tax law has been raised on everybody in this room. Everybody in this room is paying more in taxes. In the Affordable Care Act, how did it get through the Supreme Court? Because they called it a tax. The penalty's there. Example. Anybody in the class, in the tax class? I love to pick on tax students. Anyhow, your medical expenses used to be 7.5% of gross income. Now it's 10. That's on you. And you only deduct over that limit. This current environment, and I was talking to Jayme about this, in the state of New York on April 1st, a new law came into effect, and they're not going to change it. if in the state of New York, your state goes over the federal exemption, which is the really rich guys, the marginal tax bracket at the state level is 165% of the next dollar. Yep. And it is the law. That's just the state of New York tax plus 45% at the federal level. So you get $1 on the radar screen, you lose $2. You wonder why people are leaving the state of New York in droves. Because, why? Fiscal policy. Fiscal policy has required government to become confiscatory versus a leader. In the 2015 budget, 70 cents of every dollar is going to be a check to a person in this country. 70 cents of every dollar. This is a scary world. We have competitive competition. Mr. Putin is playing games over there. This is the time for leadership, and that's why the anxiety factor rises very high. Now, I could talk on this slide for a whole semester's course, but the maximum tax bracket, the maximum tax on capital gains is, at the federal level is now 29%. And on earned income, it's at 43.9%. You throw in the state and your local wage, you're giving half to government. The UN 2 weeks ago, released through the International Monetary Fund a study, and I stay up late at night reading these things. And what they have said is the United States is the world's leader of income inequity. And to be fair, every person should pay 27% more in tax. And then the United States government should redistribute that to the world. Okay? Anybody want to vote for those guys? That is the one opinion on how to serve income inequality. That's why, and an editorial comment before I shut up, my son sat down, so I don't know where he went. He's holding us like this in the back of the room. This is why the midterm election is so critical. This is why you college kids, I'm older than dirt, according to my daughter. This is your future. If you don't get involved, shame on you. Don't blame us. We screwed up, but it's now your chance. So with that, thank you, and it's the question and answer.
Don't forget about your questions. We want to respect your time, so we'll do a question speed round. If you have questions, pass them to the end of the row. We'll collect them. But just to kind of get the juices flowing, I will quiz our panel. Brian, this one's to you. 60 Minutes. A few days ago, a week ago, stock market's rigged. Why should we even worry about any of this stuff? High frequency trading, is the stock market rigged?
Yeah, good question. It's a question we're getting a lot. Actually, we got it so much we wrote a little research piece on it. And it's, if you go to Heffern.com, it's on our homepage. You can hear our opinion on high frequency trading. So maybe first I'll just define what high frequency trading is. Several years ago, the stock exchanges moved to a computerized system. So when you think about the footage you see at night of the New York Stock Exchange and you see the traders running around, that's mostly for show nowadays. Most of the trading goes on behind the scenes in computerized form. And when they transfer to that computerized system, it's an imperfect system such that there's these hedge funds and other investors that have these supercomputers, and they operate on a time frame of just milliseconds, nanoseconds, and they are able to get in to the stock market just a fraction of a second before maybe your trades do, and buy in front of you, and then sell a security back to you just in the blink. Not even, I think the statistic is something like 600 times over the time it takes you to blink your eye, right? These flash trades, high frequency trades occur. So this is something that's been going on for several years. I don't know a lot of people that are happy about it. There's a lot of investigations. It's very controversial. It's been known about. Only recently has someone made the claim that this means that the stock market is rigged. Okay, I think it was a very expansive use of the word rigged. So when I hear the word rigged, I picture a man behind the curtain pulling a lever, and that's causing the stock market to go up and down. It's manipulating the direction of the stock market. That's not happening. So no, the stock market's not rigged in that sense. Is Wall Street imperfect? Yes. Are there people taking advantage of it? Of course. It's always been that way. But if you look at the grand sweep of history, technology has been something that has greatly decreased costs for investors over the decades. Okay, and so you take the good with the bad, but there's been a lot more good than bad. And in fact, just one little anecdote that I'll close with. Vanguard, which is known as being an advocate for mom and pop investors, has said that high-frequency trading has decreased significantly their cost of business, and they've been able to decrease their fund fees as a result. So it's not altogether clear that high-frequency trading is altogether evil. There are some good things that might come along with it. But my suspicion is, I wouldn't be surprised that if it does become illegal at some point. So I guess the bottom line is, it's a lot of bad news sells, as Jim said. This is a lot of hype, but it's not something to lose sleep over.
All right. We actually just had a question on that, so that's good. We got a lot of good questions. I wish we had more time because there's a whole lot of good questions here. Let me start with a few. Tim, these are some nice fixed income questions, and so that'll go to you. We got a question on tips, bonds, and maybe I'll throw a couple of these at you. Talks about the yield curve. If the yield curve is so steep, why aren't banks lending? That may be a lending question, but maybe address the money market side of things. So bonds, tips, the question we get all the time on Sunday, and I'll let you kind of answer a bunch of these together. I've got a CD coming due, Tim. What should I buy? What's safe and pays me a lot of money? My advisor told me something about this great Puerto Rico bond that's coming out.
And those are the answers. If you want more yield, you take more risk, and that's not what we advocate. Money markets are paying nothing. There's been fear at times in the market that they're going to break the buck, that somehow money markets are going to fall below the dollar that they are every single day. That simply isn't going to happen, especially on notable national funds that we use. What do you do when a CD comes due? And that is probably the most common question that we have. Well, we have to re-examine all of your values. We have to re-examine all of your expectations. If you're just talking about CD to CD or CD to bond kind of a question, there isn't any magic elixir out there. You're in for low rates unless you increase your risk. Unless you increase, like the yield curve, unless you increase from your 1-year CD or 2-year CD and you're buying a 20 or 30 or 50-year bond. Those are the only ways to do it. But that's not true. There's another way to do it. There are high yield funds that we recommend, both municipal high yield, tax-free, Corporate high yield is not so much in favor with us right now, but if you're looking for income, these are very large funds that hold a very well-diversified portfolio of mostly junk. And there's risk in junk. But when you hold a large portfolio, well-diversified with the research staff that these managers have on hand, doing site visits before they buy these corporations or before they buy the municipalities, there's a great deal of safety in that. If they have a bankruptcy in 1 or 2 or 3 of their holdings, they can absorb that. It has very little or no impact on the share value. So for some investors, this isn't a broad-based, everyone tomorrow morning buy muni high yield funds. There's still risk to that going forward. We like the sector right now.
Great. Got, this one will be for you, Jim/Dad. I always, in public appearances, I always get a loss to what I call them. For you at the end of the table, two good questions. Both of them are kind of about the same. What's your best advice to a student preparing for the financial future? And professors in the room, whoever that is, you should give them extra credit, because that's a wonderful question for someone in their late teens, early 20s, thinking about their life down the road.
I've had a long career, and it's not over yet, but and from the bottom of my heart to you students, whoever asked that question, in my entire career, I've never undertaken an engagement where I've worried about getting paid. And first and foremost, it's service to people. And as Tim said, what are the needs of the client? The personal financial planning business, my closest friend is a cardiologist. And he's one, if you ever need a good one, he's in 50 hearts a week or more. So I got a good guy. Anyhow, and I asked him, I said, when you and your wife go to the mall, you say, well, there's one. You watch your cards. So everybody in this room, including me, needs financial advice. Good financial advice. When our new people join the firm, we first and foremost realize, and Jayme worked on Wall Street in London with 8 digits past the dollar sign, 10 digits past the dollar sign. And after 9/11, we agreed maybe you ought to get out of New York and have a life, so he came back to Pittsburgh. But the transition, and I think you would agree with this is real. And this is real. And I always tell our people that come to me for advice, a lot don't. These are people's lives you're dealing with. And we become a member of the family with our clients. We really, truly do. And if you can't take that degree of responsibility, as David Reel was, how long ago did you graduate from here, David?
4 years.
4 years ago. And Matt Snyder in the back, how long you've been with us? How long?
15 years.
15 years. He's a newbie in our firm. Anyhow, and Matt, how many times? Matt is now the manager of our branch office out here in Greensburg. We're different. And we have never, ever, ever worried about getting paid in a relationship. If you want to get into this business and have a very short tenure, worry about getting paid. If you want to have a career and do good, what is it? Do well by doing good. work for you. And I mean that from the bottom of my heart. If you can't bring empathy for the person across the desk, go be an auditor. Okay? Any audit professors in the room?
Dr. Rakulia did say if there's any students in the room that have a 9 o'clock commitment, you will not offend anybody if you have to leave. Brian, this one will be for you. Again, two questions closely together. One specifically gold, silver, and then the other one is just commodities in general.
Sure. Well, since gold, is one type of commodity, maybe I'll lump them all together. So commodities went through a long-term bull market from roughly 2009 until 2011, 2012, so a 13-year bull market. And our guess is that bull market is over. And it'll be a long time before we see another big bull market in commodities. And there were three things that led to the bull market. And we think all three of those things have reversed. So the first is increased demand. So if you think about the rise of China and the rise of emerging markets, there was such demand and such just demand for infrastructure needs that those countries were just gobbling up commodities. That's reversed. I shouldn't say it's reversed, but it's slowed down dramatically. So China, for example, is reorienting its economy. During the financial crisis, China learned that it was a mistake to rely so much on exports to places like the US and Europe, because if the US and Europe have problems and consumer spending slows, it's a big problem for China and China's exports. So they said, okay, we need to actually become more like the US, become less export-oriented and more of a consumer society. So China has been rebalancing, reorienting its economy away from infrastructure build-out, away from exports, back toward, and more toward consumer demand. And as a result of that, China's demand for commodities has lessened. Okay, so that's the first factor, demand. The second factor has to do with supply. So if you think about the last commodity bull market that began in 1999, 15 years ago, it was born out of a situation where supply was constrained because it came on the tail end of the technology, media, telecom boom from the late 1990s when people were investing in computers, they were investing in fiber optic cable in the ground. They weren't investing in copper mines or oil wells or corn acreage, okay? And so because there was little supply going back 15 years ago, when the demand picked up from China and there wasn't a supply response to meet it, it caused commodity prices to skyrocket, okay? After a decade of high commodity prices, there's been plenty of supply response. Just think about what's happened in the energy markets, right? Horizontal drilling and fracturing probably never would have happened if oil prices and natural gas prices hadn't risen so much, because there wouldn't have been an incentive to create those technologies if oil was still at $18 a barrel like it was in 1998. Likewise, in Latin America, they continue to build out raw metal capacity across the Midwest. Farmers are planting lots of crops. You have all these advancements as it relates to seed and genetically modified seeds and all these different things that are increasing the productivity of farmland. Okay, so you have a supply response. The third factor that helped commodities and now is weighing on commodities is the dollar. So around the world, commodities are priced in dollars. Whether you are in China, Europe, or the US, you use dollars to buy commodities. And from roughly 2001 until 2008, the dollar was on a downtrend, okay? And when the dollar is on a downtrend, and commodities are priced around the world in dollars, the dollar's weaker, therefore it takes more dollars to buy the same amount of commodities, right? And so just the fact that the dollar weakened caused commodity prices to go up. Since 2008, the dollar's actually been strengthening, and since the federal budget deficit has improved, the dollar's actually been strengthening. Therefore, it takes fewer dollars to buy the same amount of commodities, and therefore, other things equal, with the dollar strengthening, commodity prices will go down. So, demand, supply, the dollar, the factors that led to the big bull market from 99 to 2011 are all reversed, and we don't see anytime soon that they're going to move in a favorable direction for commodities, including gold.
All right, well, we are up against, as we say on Sunday, we're up against the clock. I'm surprised Rob hasn't given us the break signal here. I'm going to ask two questions in closing. One, Jim, great question from a client. First job, first paycheck, what should I do? Roth, traditional IRA? And then I'm going to close it out. We had a couple questions on this, and I'll ask the panel. Any books, periodicals, what's your favorite resource for your particular area of interest that maybe students or other people in the audience maybe find value in?
For a young person starting out, the only way to go is a Roth, which means you don't get a deduction on the way in, but it is tax-free on the way out. With this word of caution, I don't trust the government that they won't change the rules. Remember when Social Security was tax-free? That was changed in 1994. They retroactively changed the 1993 tax laws in 1994 to raise money. So, don't go to sleep on any investment. Sleep with your wife or your significant other, not with your money. But Roth, I'm sorry, I could talk all night on that.
Favorite, what good resource you could recommend for
A good way to start is Wall Street Journal. I read it every line, word, page, at least once every day. I read it once on newsprint and then once again later in the day online to get the updates. That's the best place to start. 99% of my reading now is the research we get in the office, which is really boring stuff. Not that you guys write, but what we all read.
First of all, I want to do over. Let's go back to that other question. There is one place that you should investigate. If you have a CD coming due, there is one sector of the market that I want to mention: taxable municipal bonds. Taxable municipal bonds are yielding higher, paying higher interest rate than any other bond market, taxable bond market right now. Investigate taxable municipal bonds.
And they're very safe.
And they're very safe.
if you do your homework?
If you do your homework, and then you got to listen to calls, so work with a professional, find a trader somewhere, and do your homework. Favorite research pages? I have a Bloomberg system on my desk that I pay about over $1,400 a month for. That does all of my research for me. It's an international company, but they do have a website, Bloomberg.com, I would imagine it is. I see a young lady shaking her head. It's a wonderful source. A wonderful source. It covers all the markets. They have great writers. A terrific place to go. So Bloomberg.com.
I would also say, if you're looking to get into the financial services industry, cast a wide net. Okay, read biographies of business people. I try to read a lot of humanities, so philosophy, theology. I'm reading a social psychology book right now, and there was a really neat situation described that I thought was a perfect analogy for the situation surrounding inflation today. And if I was just reading, books that are narrowly focused on finance, I don't think I ever would have had that insight. So I would say, cast a wide net, read lots of different disciplines, and you'll be amazed at all the ideas that you can pull in from these other areas into the financial world.
All right. Well, again, thank you for your time. We appreciate you spending an evening with us. Thank you to our panel, and thank you to St. Vincent College for inviting us.